Thank you very much, Per. Thank you, everybody. And thanks for inviting us. Per said at the very beginning that we are the odd one out as we do not relate to mobility. And I thought of a mobility analogy as I thought of describing what it is that we do in Babylon. If you remember the old days, when I used to drive my car, I used to have I used to drive it until it broke down. I took it to a mechanic, they fixed it. I drove it again until it broke down. That's what you do with your healthcare. We wait until things go wrong and then we go to a doctor to fix it. This thing that we call really healthcare, it really isn't healthcare. It's sick care, it's reactive, it's episodic, it's physical. One size fits everybody. And we think that the true way to fix somebody, to deal with this, is to create a model of healthcare that is proactive, that continuously monitors people, that is there for them all the time, as we do with our cars, that we buried so many sensors in our cars that they never almost break down anymore. There is really no reason why we cannot do that with healthcare. But to do that with healthcare, we need a fundamentally different infrastructure than what it exists today. We need to start by collecting everybody's data. We need to analyze that data in real time. We need to be able to identify from that data when is something going wrong and be able to intervene early and then intervene so 24/7 wherever people are virtually first and then bring them down to do so physically. And in doing that, we need to make sure, because nobody can watch every human being's data all the time, we need to make sure that we have created enough AI agents who can watch that data in real time. We do that with so many of our assets. We do it with the cars, we do it with every light in this building, but we do not do that with the most precious asset we have, the human body. We just wait for crisis, for emergencies to happen in healthcare, and then we just throw a huge amount of money at it to fix it. So what we're doing in Babylon, in a nutshell, is to build that infrastructure, to build the ecosystem that is necessary to deliver that service. With that, we start with what we call a personal health graph for every individual. We take the data that you generate, whether it's from your watch or it's your hospital or your clinical data, and we collect it all in a single health graph. So everybody, including your doctors, have access to that in real time. If I ask you now to show me all of your health data, any of you, I will be surprised if there is anyone in this room who has it immediately available. Any of you have got your health data immediately available? Not a single person. And remember, you are among the top 1% to 2% richest people on the planet, living in some of the richest countries on the planet. And we don't have it. Something that's simple as that. But having that data alone is not enough. What we then need to do is stream that data in real time and create, as I said, agents, AI agents or non-AI agents, but agents who can watch that data. I did my PhD on interaction of waves and currents and how the change on that matters, the differential equations. Nobody's looking at the differential equations in our data. So we need agents that can look at that data. That's what we're building. By the end of this year, we will have tens of these agents that can look at every variation in that data. And we need to be able to then find out who are the 20% who usually are responsible for 80% of the costs, and then identify those 20%, and then we monitor them continuously in order to be able to reward them if something goes wrong, but more importantly, alert them as the things are going bad and intervene early when necessary. When we intervene, we give people a 24/7 health assistances that are available to them all the time. That those health assistances, when necessary, you can talk to a doctor or a specialist in real time on your mobile phone. And then when necessary, we'll send you to a local doctor who can see you physically. Only 1 in 10 times that will become necessary. And then as we do that, if you need to be hospitalized, we have the capability of sending you to a hospital and bringing you back and help you to recover. We deliver your medications at home. And if you're seriously ill, we give you a care team that can look after you. And by doing that, we can manage all the complex and care situations across what we do. That's in a nutshell what we do. And we try and do that in the most rational way possible. So we take your data, we have the insights, we activate our people, we set goals for them, we then monitor them continuously with almost no human in the loop. All of that happens digitally with near zero cost of human beings involved. If you need to talk to a doctor, we first try to get you a non-clinical person to deal with your problem, which is significantly cheaper than a clinician. We call this our pyramid of care. If you need to talk to a clinician, we first do so virtually. As I said, 9 out of 10 times, all your clinical records happen on your mobile phone. And they're wonderful, by the way, speaker before me, which I thought has a brilliant, brilliant business, and he's a brilliant entrepreneur, mentioned Rwanda being one of his key countries. We could do that in Rwanda. We now provide about 5,000 consultations in Rwanda, as well as United States. So that model is so scalable that you could do it in one of the poorest countries per capita in the world, as well as one of the richest countries in the world. And when we need to send you to a physical place, we almost lost the battle, but we will send you to a physical place too. We started that business in United Kingdom, and I'll come to that, but just briefly on how we make money. We make money by either licensing our technology to somebody or delivering services for a fee, or much more importantly, what we really like to do is to take the entire budget of a patient and take the savings of because of the way we do. We believe that if we monitor you continuously and try and keep you at the peak of your health, we can avoid the expensive emergencies and crises, and those are the places where all the costs are. We did that for the National Health Service in Britain, where what we saw is that for our cohorts of patients, in a country as frugal as Britain, we can save up to 35% of the totality cost of a patient when you compare our cohorts versus the average cohort in the country that are the same as us, live in the same areas, are same age, the same social economic backgrounds as us. So we took that model then to United States, where we could hold the whole budget of the patient. And when we entered the United States, we analyzed that what exists here. And what we saw is that the country has a lot of mom and pop shops in primary care, if you wish. These are single individual doctors. Then you have businesses that have gone in. Agilon is a great example of it. Is now almost a $10 billion valuation business that have created almost a franchise model for these mom and pop shops where they join them. Then you have businesses, Oak Street Health is a great model of it, which have created shops, which is kind of delivers the same model across the country. But we saw that there is almost nobody who is doing the Amazon, who is basically doing a digital first primary care model that can manage population health at scale. And while many people, and currently, especially with today's world, love the model of shops and clinics and doctors going and visit them in the place, I have the benefit of age. Even though I look 75, I'm more like 55. So I've been around for a while. And I remember when back I was sitting on your chair when I was at Goldman Sachs, we used to love companies like Bad Bet and Beyond. We love this shops because we thought the idea was that if you have one shop, you can have it in every neighborhood, until somebody came in and digitally cleaned that business and washed it away. And we are absolutely convinced that whoever builds the infrastructure of the new model of healthcare will do exactly the same in the healthcare section. So we came to United States, which is now our main market. And what we saw that almost in January 2020, before the COVID broke down, was the last time I could come to United States. Then again, I could come again in January 2022. So in a space of 2 years, less than 2 years, entirely remotely, without even being able to visit the country, we built over 4 million customers, like individuals that we serve. We, much more importantly, where we take the entirety of the budget, we went from only 17,000 people in our first contract in October 2020 to now over 270,000 people whose entire budget we hold. We went from $29 million in revenue to $228 million in United States alone in 2021. So when you speak of growth, this is a tenfold growth. And this year we'll do around $1 billion of revenue in the US. And that's in 2 years, built in 2 years. And throughout this incredible growth, we maintain 95% satisfaction and net promoter score of over 70%. For any of you who've built businesses, you know growing is easy. Holding a small group of people really happy is easy, but growing really fast and keeping your customers happy is super hard. So now I want to share numbers with you, but before doing that, we have just recently announced that we were super lucky to have David Humphreys as our new CFO. So I want to introduce David to you. Not only is significantly better looking and younger and more articulate, he's also been at PwC as a partner for about 20 years. He looked after companies like Facebook and Tesla, and he will be a good way of introducing him to you to take you through the numbers.
Great, thanks, Ali. All right, so let's spend a few minutes here just on the numbers. Let me start with a little bit of an overview of what we reported out as a public company at Q2, and then talk a little bit about what's next for us, and particularly where, from a financial standpoint, I think our core areas of strategic focus are. So as Ali said, our growth here has been spectacular, right? And we're looking on track for over $1 billion of revenue this year. But when I think about what's next for us and what we've really been focusing on, it's really making sure that's the right growth for us as a business, and that we're really optimizing that growth from a profitability standpoint. So what do I mean by that? Well, one of the big areas of focus has been diversification of our revenue portfolio. So as Ali mentioned, a lot of our focus has been on this area where we're taking population health under our value-based care arrangements or Babylon 360 arrangements. But those come in different flavors, I'll call it. We really started in the Medicaid space in the US. That's been a great sort of starting place for us to really build our reputation, execute upon our business model. But as we look out longer term, we're really keen to diversify our mix, particularly into what we would call the Medicare or commercial space in the US. That's where we see longer term, as we look out, a better fit for our business model and frankly, some more upside from a profitability standpoint going forward. The next bit about how we optimize these populations and work with them is thinking about our level of engagement. As Ali said, our product and being digital first is pivotal to our model. And what we're really focused on is optimizing the engagement of those members we take the health risk on with our application, getting them on board with our digital first product, making sure that is the first step they're thinking about as they work through the healthcare journey. And we've really become a lot better at that. How have we done that? We've learned. We've been relatively new in this space. We've been learning quickly about how to, for example, get better data on our members ahead of entering into these arrangements, so we can really understand the membership we've taken on, really understand what the healthcare needs are going to be. And to Ali's point earlier, think about really focusing in on those 20% of our members that have the biggest healthcare needs and are carrying the biggest healthcare costs. What does that enable us to do? Well, it really enables us to focus in on what we view as some of the key performance indicators, some of the early indicators of what's coming from a financial standpoint. Things such as patient admissions and lengths of stay that our members are staying in hospital visits are key areas of indication of how our business model is operating. Why is that? Well, those are a couple of the areas where the biggest healthcare costs come through. To the extent we can be proactive, get ahead of the need for our members to need to be admitted into hospital, manage them effectively if they do go in, to reduce the number of stays in hospital, get them into aftercare programs as soon as we can. That really not only benefits the member in terms of the quality of healthcare they're getting, but also is pivotal to us executing on the margin growth story here that we're seeing across our portfolio.
Sorry, can I just intervene for 1 second? Just to share some numbers in here, because I think, David, it's super important for people to understand this. Just look at these numbers. What that shows you is that as we penetrate into our population and go and engage as little as only 25 to 30% of them, what you will see is that inpatient numbers, inpatient admissions, that is the people who go into a hospital where all the costs are, fall from 120 to 80. That's a 40% reduction in hospitalization in our population. I mean, that is huge. And for those of you who understand healthcare, and the more importantly, those who also go to a hospital, what you will see is the number of nights stay in a hospital goes from 4 to 3 in average. That's a 25% reduction in that number too. And if you equate the cost in a hospital is equal to per night, what you see is a massive reduction of 40% on one hand and 25% in the other hand. And what you will see is that as a result of that, we could get to medical margins, that is savings from what insurance companies could do, of over 20% in our commercial deals and about 10 to 15% in our Medicare deals. So an insurance company has spent 20 years adjusting how much they spend on these things, reducing these numbers. And within the first year, we could manage to bring the prices down by 10% or so. Sorry, David, I just wanted to emphasize the numbers.
Yeah, no, I think that's great. I mean, and that's where, frankly, we're just seeing such momentum as we get better at this over time, and seeing the data coming through here. It has been huge for us as we continue to grow out, I say, the right revenue base. The other piece of the business model, though, is just thinking to Ali's point earlier around how scalable this is. We've seen the revenue growth. We've seen the significant increase in membership we're taking on, but we're also continuing to drive costs out of the business and really see that growth as positioning ourselves well for the next steps here towards profitability. Flashing up our Q2 numbers, I think we're very proud of the fact that, we've been a public company now for, coming up for 12 months, and we've been able to meet or exceed all of the sort of financial targets that we've put out over that process. That includes revenue metrics, but also our adjusted EBITDA metric or profitability metric that we've been working towards with investors and with the analyst community there. So how have we been able to do that? Well, we've talked about the revenue growth. We talked about that switch in terms of the portfolio mix on that revenue. And that's really helped us on the adjusted EBITDA piece, along with also that focus around the operating cost leverage. Let me pick up on that a little bit further, because since Q2, we've also announced a very targeted initiative here looking at the cost base. As we say, we view this as being a very scalable business and really wanted to look hard at what extra we thought we could get out of the cost base, not least as we really focused in our business model. We've really arrowed in on the core areas of focus. We talked about the switch into commercial Medicare in the US, big focus there. We've had a look at, what our other activities in the business are. Was there anything that we don't view to be core going forward that is an area of cost-saving opportunity? Do we have some existing efficiencies we can really drive in terms of how we're contracting, how we're engaging ahead of our new value-based care contracts? A great example here is I talked about getting that better data in. We're also laser focused now on working with an actuarial team that we built up in-house. They give us the intel ahead of time to drive some contractual improvements, make sure We're able to execute on new contracts in a profitable and cash flow positive manner out the gate. We've looked at some of the acquisitions we've done. We've done 4 acquisitions in the last 18 months, 2 years or so, really thinking about the synergies we can get out of them. Where are the cost savings? Where can we bring the digital first platform into those businesses to really execute strongly around the margins? And we've also just looked at our geographical footprint a little bit as well. Like many, thinking through the right balance, remote versus physical, driving some cost savings initiatives through some reduction in some of our physical locations. We still think getting people together in person is a good part of our business going forward, but there were some cost savings opportunities we've identified there. So we're committed here to deliver around 100 million a year cost savings going forward, and feeling good about the trajectory we're on since announcing this in July of this year. And this point around scaling is really key to our focus on profitability. All these pieces we're doing around our margin mix, our focus on driving the right behaviors around our high-risk members, our focus on engaging them in a digital-first mindset when dealing with their healthcare, layering on some of the opportunities we see to optimize revenue streams relating to our digital platform, just through licensing arrangements, through new commercial partnership deals, and delivering that along with this real focus we've got on our OpEx base here going forward. You know, we're feeling good about the path to profitability here, given the experience we've got and history of delivering this kind of growth scale in the business. So where does that leave us as we look ahead? Well, we've got great momentum in our value-based care business. I've mentioned that a couple of times, but the growth is there, and more importantly, we feel it's the right growth. We're really focused on that engagement of our members, making sure they're really engaging with our digital-first platform. We see that diversification in the value-based care business really coming through. That is important to us. When I think about the deal pipeline here going forward, it's very heavily weighted towards that commercial Medicare space where we feel there's a larger margin opportunity. And finally, we're laser focused on the OpEx execution. We've announced that program. We're a long way down the path on executing it, typically around the people costs, and seeing those savings really come through. And we'll see that certainly in our Q4 results. And that will really set us up well in terms of exit rates into 23 and continuing the excellent revenue growth that we've delivered so far. So with that, we're looking forward to what's ahead.
Trying to better understand the legal risks associated with value-based care, specifically for a digital operator versus a legacy operator. Is there anything you can comment on there?
We don't see a legal risk any different than any other groups, hospitals, businesses. Legal is very interestingly, as a business, when we first wanted to come to United States, everybody scared us of the legal challenges in United States and litigation. David, I'm right to say that in 2 years of operations in here, we're probably the only business I know of that has not been sued even once, right? Not a single legal case. And the reason for that is really simple. When you go and see a doctor, what happens between you and that doctor is in that room, is your say versus her say. When you're on our platform, everything's recorded. The doctors know that, and you know that. So therefore, there is no room for things going wrong in a way. And if they do, they're recorded so one can act on very quickly. It's a much better model of care because when you see a doctor, what they tell you is about their knowledge. With us, you will eventually, what the doctor tells you is about the collective knowledge of humanity because the AI things is helping them to understand what is the best treatment and the best course of action for you every time.
Thank you. I have a few questions. One is relating to an earlier guidance that you have given about EBITDA losses on a monthly basis of, was it 16 million on a monthly basis? Is that correct?
So we're going towards at least we're going towards a minimum of 18 as exit for December. But remember, not all of the savings coming in from the OPEX initiative that we announced will hit in December. There's a little bit of extra benefit we forecast coming through in 23. So we really view that as an exit rate with, you know, some upside going into 23 as we look out.
So further improvement in 23. Can we go back also to the matrix that we had with the blended gross margin? This one, yeah, exactly. So to interpret that, is that you have the revenue numbers on top, like 1, 2, 3 billion?
That's right.
Then you have the gross margins on the side. So it looks like you could be profitable then sometime somewhere between 3 and 4 billion. Or?
That's right. And it's important I would point out, because we try to use the slides we used as part of Q2, that actually that operating cost line is prior to really factoring in all of the additional OPEX savings. So when we look to sort of refresh that with our minds in Q4, with the full benefit of our cost savings outlook, you know, we expect that metric to look more favorable, because, you know, we're really, as we said, really focused on those margin improvements and delivering those OPEX savings.
So the OPEX level will come down, basically.
Correct.
Yeah. Okay. And then I have also on the existing contracts that you have done, and with the graph where you showed the margins on commercial, Medicare, and Medicaid. Can you give an example? Is the contracts that you signed maybe this year, are they sort of higher quality or better structure than the earlier contracts? Or?
So it's a really interesting thing. When we grew the way we did, being very frank, a lot of your peers in this country ask our US competitors, how come these guys come from outside and can grow so fast? And then they started saying, because they take bad contracts, right? And at the beginning, of course, we couldn't show it. But what we now showed is that there isn't almost a single contract we've taken that in its very first year almost has been loss-making. So almost every one of our contracts, give or take, on aggregate, are profitable on year one. When you compare that with the brick and mortar competitors we have in the United States, it often takes them 3 years before they can show profitability on every contract. And one of the reasons we achieve that is because actually we've been incredibly diligent on the contracts we take together with our partners, because our message to our partners was, if this works, it's going to be a game changer for you, because you could deploy population health digitally first across a very wide group of populations everywhere. You don't need to build clinics in every village, in every rural area. You could deliver this service widely, but we both have an interest in the early contracts to work. And the fact that our customers are now starting from $15 million of contracts and are now giving us a run rate of $1 billion in contract, shows that how successful these things are. None of our contracts, David, if I'm correct, with the exception of maybe one, is loss-making today, right?
Yeah, and I think the other thing I was going to say is also we're really focused on the new contracts, to Ali's point, being incrementally better in year one than they were 12 months ago. So the focus we've got in that contracting phase with our partners, the focus we've got around, you know, getting more rigorous data ahead of time to really make sure those new contracts we layer on in the portfolio are incrementally profitable out the gate as well, even more so than the sort of original ones we took on 2 years ago.
So it sounds like you will be able to take on new contracts if they are profitable in that rapidly. You will be able to continue to take on new contracts and maintain a high growth, maybe not as high as historically, but still decently high for the next few years, or how do you? look on that?
So we can certainly do that. Look, if you look at a very key growth area for us, which is year 4 to 8, which was our last 4 years. And those are what you call in the digital sector, you call them the scale up areas. So at the beginning, you have a thing. At the scale up period, we have a graph that we showed some time ago. Babylon's compounded growth was on par with very small number of companies in the world. And they were Spotify, Amazon, Google. And if you just look at those at the scale up area. So we kept that momentum. We can still keep that going. The reality is that you, the investment community, last year, this time, all you wanted from us was growth. This year, you've kind of changed, flipped, and now you want from us profitability. We'll be a fool not to listen to this. So now there is no rewards for growth as such. So we will focus on profitability of the business. For me as a builder, as an operator, because at the end that's what I am about, for us, this is about building the infrastructure. Once you build the infrastructure and the factory, how many cars you put through it, how many contracts you put through it, really makes very little difference in operation. It's massively scalable. And we've shown that the scalability.
Thank you.
We had a question at the back. Hello. Okay. So increasing share of Medicare revenue in the last few quarters. What do you think that mix is going to be going forward in the near, mid, and long term? And how does that impact both your operations and your financials?
So for those who are online, unfortunately, your thing has stopped working. But your question was an excellent question. And that was that the mix of Medicare is increased significantly in the last couple of quarters. And do you see that going on? We absolutely do. In United States, in particular, Medicare is among the more profitable parts of the revenue mix, partly because the government is more generous in what it pays, the needs of the users are more, and you have many operators in this country who only focus on Medicare. We believe that every part of humanity needs to be served. We don't think that if you're poor, you should not be served, and therefore we started with Medicaid. We showed that an area that others didn't want to touch, we could do very well in, but we will actually, we have to also be sustainable. So we will focus increasingly on Medicare, as you quite rightly suggest. But the most important thing for us today is that when we first came here, people told us no company has ever come from outside United States and has built a healthcare services business in United States. We proved that that can be done. Now, nobody's questioning our ability to scale. The question now is, can we make this profitable? So our focus is going to be much more on making sure that happens. Because when you have contracts that are profitable, cash flow profitable, more importantly, then you could basically turn the tap on and scale as fast as you want, really without any question. I mean, there isn't an insurance company you will go to today or a payer that you could say that you have two choices. You could wait until your members get sick and just pay their bills, or we can come in and manage them upfront proactively and reduce those bills and take your net promoter score often from being negative to what it is now with Babylon. That sales is not a hard sale. Our question is that we need to generate cash as we grow.
Thank you. Any other questions? There's a question from the broadcast.
Thank you. So one from the broadcast. In your view, what do you think could be a catalyst that could help the stock, or more specifically, I guess, the market realize value, and how can you make that happen?
So I'm the last person to ask, because if I knew anything about the markets, the very last thing I would have done was to bring it public at the time that I did. We did. It is what it is. Somebody asked these questions recently to Jeff Bezos, that how did he feel when his market cap fell 96% from $110 to $6 in 2001? And what he said was that while the performance of the company and the performance of his stock is not the same, the job of the management is to look at the performance of the company. And what he was looking at is that his metrics are improving year on year, quarter by quarter, by staggering amounts. And eventually the markets will come and see it. It cannot be that the markets were right a year ago when we were valued at $4 billion, and it's right today that we are valued at 200 million, whatever it is. At some stage, one of these two numbers or both of these two numbers need to be wrong. And I think it was Benjamin Graham who said that the market has its habits, but the job of investors is to sell to the optimist and buy from the pessimist. And it's up to you to judge when pessimism has taken over, right? But our job is to make sure this company keeps doing it. And even in these markets, on almost every metric, multiples of revenue, this, that, the other, we're at significant discount. Our job is to make sure that that happens. It is also true that our company is not fully financed, and people will look at that, of course, in a world in which you're not fully financed. I think the market is just, sometimes I wonder whether they can't see, there's some very basic metrics on this. I'll give you an example. We have one asset, publicly known, an IPA, which is a collection of our doctors. Those assets trade at 15 to 10 times EBITDA. That asset of ours alone will do anything between 20 to $30 million of EBITDA next year. So that asset alone should be worth a significant amount more than our own market cap. That's a small part of our.
On that note, we say thank you so much, Ali and David, for a great presentation.